To the topic in hand, I mean, it would be curious. It would be curious for me to have any, in principle, objection to the own initiative report, since I think what Econ have largely set out for us is pretty consistent with ring-fencing approach that has been introduced in the UK, following the recommendations of the Independent Commission on Banking, chaired by Sir John Vickers. At least that's how I read the report, whether in paragraphs 9, 12, or in some of the aspects that follows. And what usually happens when the EU is looking for a blueprint on which to base a new legal or regulatory requirement is that representatives around any European policy table usually find that, for very good reason, they decide to support their own national approaches. The good reason usually being that it makes life easy. You go through it once rather than twice. I can think of only one possible exception over the last couple of decades of sitting around talking about banking issues, and that was a very complex proposal concerning shareholder rights and custodians. The intervention of the Italian delegate, and she was perhaps the most expert person in the room, was that on that occasion she didn't much care for which approach was adopted, so long as it wasn't the Italian one. In this instance, though not quite in such stark terms, I'd say that in discussions around the European Banking Federation, I felt that my role has been to provide reportage on Vickers separation, rather than necessarily advocating it as an approach that necessarily should be applied on a mandatory basis across the entire EU. Having said that, I have no quarrel with what I think are the three stated objectives of Vickers ring fencing. It arguably does make it easier to sort out both the ring-fenced and non-ring-fenced part of a bank in the event that they get into difficulty without taxpayer-funded support. It certainly insulates vital banking services upon which households and SMEs are dependent. And certainly, or arguably, it curtails the implicit government guarantee through which it's asserted that large, too-big-to-fail banks benefit from cheaper access to funding. What I'm unsure about, though, is whether I'm convinced that ring fencing is necessarily appropriate as an EU-wide measure for mandatory application across all 27 member states. Apart from the question of whether others necessarily view the implicit guarantee in the same cultural way that we do in the UK, I'd explain my sort of doubt, scepticism, by reference to both diagnosis and purpose. First of all, in terms of diagnosis, the political debate in the UK has been a very febrile one, and it's taken place against a backdrop of a political soundbite that determined, above all else, we must offer protection against casino banking. And yet the crisis wasn't even about investment banking in the UK. If you look at Northern Rock, Bradford and Bingley, Dunfermline Building Society, Halifax Bank of Scotland, and even RBS, these are not investment bank casualties. The same is true if we look at the financial crisis and the way that it's visited other member states. Our chairman, perhaps, has already mentioned that this is epitomised when you look at the way in which the crisis impacted, particularly in Ireland and Spain, where the root cause of their banking failure wasn't investment banking. It was bad retail and commercial banking decisions, principally real estate. And I'm unaware of any empirical evidence that supports the view that universal banking as a model contributed to the financial crisis. Certainly that was the view when the European Central Bank looked at this, I think, back in September 2010, just as the Vickers review was first getting underway. If I then look at the question of structural separation from the perspective of purpose, my question then would be, what does it give us that other measures, if finalised and if applied consistently across the EU, and there's two big ifs there, won't give us, providing we get some of these measures across the line? Because I do think that the answer of what was needed lies principally in some of the measures that have been taken, some of the measures that are in train, and some that actually we must make sure that we deliver. So we have the increased capital levels set out in the various capital requirement directives, increased liquidity standards, improved firewalls via EMIR. And I think you can add to this stronger governance, stronger risk management, firmer banking supervision and regulation, a further racking up of capital within the trading book. And I think, as suggested by the previous speaker, let's make use of counter-cyclical capital tools, she mentioned loan-to-value ratios. In the UK, we've empowered the Financial Policy Committee to be able to use sector-specific capital measures if it so wishes. So in other words, if it sees part of the market overheating, and it typically is commercial real estate, then actually you can take pinpointed action against that. But I think the big prize for the Irish presidency, if CRD4 wasn't already a big enough prize, is the Recovery and Resolution Directive. Most of the way there, but I think European experience tells us that until the ink is absolutely dried and the document delivered, then you don't assume that it's inevitable that agreement will be reached. This proposes a pan-European approach to recovery and resolution planning, stronger supervisory crisis management coordination, and the introduction of a bail-in regime for senior creditors on a common European platform. And indeed, I'd add, one which should respect the €100,000 deposit protection limit. This, to my mind, is the single most important financial stability measure yet to be agreed. And I think that every effort should be put into getting that across the line during the Irish presidency. Perhaps we're there. But I see that, further amendments, discussions and so on take place. If you achieve that, and with the other measures in train, then I'm not entirely convinced that mandatory structural separation, as opposed perhaps to a fallback power for supervisors, necessarily adds a great deal. And I repeat, once we're operating in a bail-in environment, I think this measure is really critical. So I think it's incumbent, therefore, for the Commission to pay close attention to whether the perceived added benefits of structural reform outweigh any potential consequences, intentional or otherwise, for long-term economic growth. And I'd add, I think, the same for the financial transaction tax, which even on a partial basis, I think could have a devastating blow on Europe's underdeveloped capital markets. If, however, we do conclude that there is something to be gained from structural separation, then I would say look at Vickers. But in doing so, let's make sure that we learn from the difficult discussion that we've had in the UK and some of the issues that I think we've discovered are more complex than first meets the eye. For example, 2 years on from the delivery of the ICB's final report, I'm still not sure that we've found the answer to ensuring that ring-fenced banks can indeed provide the services that SMEs need in support of their import and exports. Look at Vickers ring-fencing. The reason I say that is a simple one, and that is if I look at some of the models that are being promoted elsewhere, they seem to be based on some kind of version of the Volcker rule, and I'm not so sure that even the Americans are finding the Volcker rule that easy or as easy as first meets the eye to put in place in practice.